Stovall's with me, Chief Investment Strategist at CFRA Research. He's with me from Pennsylvania. All right, is this where the salami slicing begins as we go into next year? This slow, gradual, as reality permeates, that the first 6-9 months of next year are going to be hard.
Hey, Richard. Yes, I equate today to be like a deflating Santa Claus lawn ornament. Today's sell-off reflected diminishing investor optimism that the U.S. will avoid recession. So I think the first half of 2023 is going to be very challenging as the markets probably have to retest the October 12th low and maybe even go on to set an even lower low.
Wow, now that's different because we had the June low and we thought that was of this year. Then we tested and beat on in October. And you're suggesting that we haven't priced in a recession yet, even though to any sane person, a recession has been obvious.
A lot of people are saying actually that they felt that we would be able to engineer a soft landing. I think a lot of economists had been building that into their forecast. And by seeing today's retail sales come in much weaker than expected, housing data likely to be weak when it comes out later this week, and also just expecting to see a slowdown in overall economic growth, I think now it's becoming much more of an inevitability that we will fall into recession. Now the question is whether it will be a mild one or a deep one.
But Sam, anybody who looks at the chart of interest rate rises since March, and you see that vertical, almost vertiginous rise in rates, and not even a stepladder, it's straight up. At some point, the economy was going to feel the effect of that 425 basis points in less than 9 months.
Well, you can add to that the year-on-year negative reading in leading economic indicators. And I think we are also now building for an earnings recession in which the fourth quarter of this year and the first 2 quarters of next year are expected to show year-over-year declines. History basically says, yes, watch out for recession. But I think many people felt that we could be able to sidestep it because of the strength of the employment sector, that with the unemployment rate at 3.7%, traditionally you don't fall into recession until you hit 4% or higher, which is probably something we will end up seeing in 2023.
Okay, so we have concurrent, not coordinated, interest rate rises of all major central banks. So there is, and China, of course, is reopening, but it's going to have a COVID problem in the new year as obviously the infections rise. So there is no safe harbor. There's no port of call. I've got loads of metaphors and similes today, I tell you, they're pouring out. There's no engine of growth that's going to pull us up the hill.
Right. Well, usually in a recession, there is no place to hide. Sectors are called defensive because they lose less than the overall market. And the old saying is that when the going gets tough, the tough go eating, smoking, and drinking. And if they overdo it, they have to go to the doctor. So the consumer staples and healthcare sectors, along with utilities, tend to be those that hold up the best, but they still decline nonetheless.
We will see a sharp fall in inflation next year, even only on base effects. And these interest rates will take, look, they're going to do the medicine. They're going to do what's necessary. When would you expect a turnaround?
Well, I think first off, the Fed likely will be ending their rate tightening program sometime late first quarter, early second quarter of 2023. I think they'll hit the pause button. And history shows that the Fed starts to cut interest rates an average of 8.5 months after their last rate hike. So that would put us squarely into the end of December of next year. And since the Fed is data dependent, if the data tells them that the economy is slowing too rapidly, then they probably will start lowering rates later next year.
Sam, good to see you. Thank you. I appreciate it. We will talk on more cheerful matters in the future. I do promise you. Certainly before Christmas.
All right.